Hi, and welcome to the Bloomberg Intelligence channel. We'll be taking a credit moment today to discuss what still remains one of the biggest euro bond issuers, which was nationalized by the French government during the energy crisis. And this means that although unlisted, there is still a very significant corporate credit exposure out there. Paul, thank you for your time today. Following on the nationalization and given that the energy crisis has eased since then, in your view, what's the outlook for EDF at this stage?
Yeah, hi. Well, if we look back at what happened to cause the nationalisation, it was the exceptional regulatory measures imposed by the government and the discovery of corroded pipes in nuclear plants that led to unplanned outages for EDF. They had to replace that energy at a very high cost. That led to a €5 billion loss in 2022. There was a capital increase before that, turned out not to be enough. So it forced the nationalisation. Now, if you look at what's happening in 2023, it's a very different story. Those regulatory measures have been removed. EDF is on track with its repair programme. It should be completed by year end. So nuclear output is getting back up to target. And if you look at what happened in H1, they generated an EBITDA of 16 billion, which was a record for a half year. And in our view, they're on track for at least 25 billion for the full year. So it's a completely different earnings picture for EDF. At the same time, that's allowed them to reduce their adjusted leverage target down from 4.5 to under 4 times, which puts them in line with peers and gives them a stable platform from which to sort of stabilize over the next couple of years, we think, and certainly result in credit quality probably bottoming out where it is. And we see, positive prospects for earnings. We think they're sustainable. We think higher power prices can be sustained over the next couple of years. So basically, it's a very different outlook for EDF. It's a much lower risk entity now than it was before the energy crisis.
Right. So given that context of stability and also taking into account the objectives that EDF has set for itself, how important is government support at this level for the company's credit profile?
Yeah, it's still absolutely critical for the credit profile. On a standalone basis, S&P rates it a BB-, which is very low, but it does add 4 notches of support for states, or uplift, for state support. And this is very justified because they backed a capital increase. They converted the Ocean bonds into equity. They've cut the dividend, and of course they nationalized it at a cost of around 10 billion euros. So the government is behind EDF. It's certainly central now to France's energy policy, where they want to build new nuclear plants over the next few decades. So they're very much, their interests are aligned. The next big test for EDF and the government will be the update of the regulatory formula by the end of 2025, where they have to ensure that EDF can earn enough on its nuclear output to cover its costs, make a profit, and carry on, on a stable basis over the very, very long term. And they can build those nuclear reactors. They can deliver their energy policy without further government support. That's the next big test. We think the French government and EDF's interests are aligned. We think maybe some opposition from the EU, possibly from neighbouring states in the EU. But again, those are negotiations going to happen over the next couple of years. For those couple of years, I think EDF is in a very stable and positive place.
So given EDF's capital structure is composed of various debt instruments, but the equity is no longer available, let's focus a bit more on the hybrids. What do you think are the prospects for these at this stage?
Yeah, well, the hybrids are certainly one of the lowest rated in the market. They are B+ rated, but they do have 1 notch of uplift for state support. Again, that's justified because during the crisis last year, the government could have deferred coupons to absorb the losses. It didn't. They could have extended the hybrids when it was cheaper to do so. They didn't. They kept calling and replacing. So EDF remains a good actor in the hybrid market. It's got the state support. Yet the hybrids are still trading about 100 basis points wide of peers. We think as credit quality is stabilized, as leverage has come down to target, it's got a fairly clear runway for the next few years. We think that 100 basis points gap to peers can probably close by around 50 basis points. We don't see great credit upside because there's still some very long-term risks surrounding EDF before the rating agencies are going to really look at it from a more positive outlook. But we certainly see scope for those hybrids to tighten relative to peers, probably from 100 basis points wide into around 50 basis points we see as more of a fair value, which is why the EDF and particularly the Euro hybrids are one of our focus ideas for this year.
Perfect. Paul, that sounds extremely interesting. Thank you very much for your time.